Have you ever felt like you're literally doing absolutely everything right, but your financial scoreboard just refuses to move? You know the feeling. You're saving, you're investing early, you're working insanely hard, but you're just not getting ahead? Well, listen, it's not your fault. You are just playing by the wrong playbook. Because after looking at how self-made billionaires actually operate, this massive paradigm shift becomes so obvious. Money doesn't follow rules. Money follows laws. And if you are sick and tired of playing a game where the odds feel completely stacked against you, you're going to want to pay close attention to this explainer, because by the end of our time today, I am handing you the ultimate decision-making tool. We're talking about an exact 5-question system that you need to use before you invest a single dollar. It's going to guarantee you understand your downside while setting yourself up for massive asymmetric upside. Stick around for that because it's a total game changer. But first, we really need to break down the actual mechanics of wealth. Okay, let's dive right in and shatter the status quo. To make real generational money, you absolutely must abandon traditional money rules, like just aggressively saving or working longer hours. Throw that out. Instead, we need a system built on 3 key laws: momentum, structure, and asymmetry. Basically, momentum compounds your money over time. Structure dictates who actually controls the outcomes. And asymmetry? Well, that maximizes your upside while strictly capping your downside. Let's start building this foundation. Part 1, the engine. We're looking at speed, time, and power. Let's see exactly how fast money moves, and more importantly, who controls it. Now, Law 1 states that while money absolutely loves speed, wealth loves time. Check out this contrast. Take 2 real estate investors over a 5-year stretch. Investor A acts fast, right? They're hustling, finding off-market deals, flipping 100 homes. They make some serious quick cash. But investor B takes a completely different route. They buy 1 single-family property and wait. Then maybe a 4-plex, and wait. Eventually, they roll that into a 20-unit complex. No flipping whatsoever. Fast forward 5 years. The flipper has fast cash, sure, but the buy-and-hold investor, their net worth is 5 times higher. People always confuse fast action with fast results. Real wealth is built by making a great decision and just giving it time to bake. And honestly, nothing illustrates Law 1 better than this mind-blowing number. 5,000,000%. That is Warren Buffett's total return with Berkshire Hathaway from 1965 to 2024. He didn't trade in and out every day, he just completely embraced the power of time. By buying high-quality companies and simply holding on to them forever, compounding at almost 20% a year, he absolutely crushed the S&P 500. So remember, the absolute best partner you have in wealth creation isn't your effort, it's time. Once you get time, you gotta ask, who actually benefits from it? And that brings us to Law 2. Basically, he who gives the money holds the power. Think about it. If you look at the Forbes 400 list, literally 0 people made it there just by collecting a hefty salary. A few made it by selling a business, but the vast majority are what we call the buy and build elite. These are the people who continuously buy assets to unlock massive value. I mean, Facebook bought Instagram for $1 billion, and today, it's worth over $45 billion. Google bought YouTube. Elon Musk bought Twitter. Mark Cuban bought the Mavericks for $285 million back in 2000 and recently sold a huge stake at a $3.5 billion valuation. The buyers hold the ultimate power because they bring the capital and they set the terms. Even if you don't have billions in cash, adopting this buy and build mindset is absolutely crucial to creating massive momentum. Moving right along to the mechanical tools of wealth. Part 2, the multiplier, leverage and equity. This is exactly how the ultra-rich take what they build and multiply it. So the crucial secret we need to talk about here is leverage. It is, without a doubt, the #1 economic growth engine on the planet. It's the tool that allows entire trillion-dollar industries like private equity and commercial real estate to exist. At its core, leverage simply means using borrowed capital to multiply your potential returns while unlocking some pretty sweet tax advantages. Let's just quickly walk through the math to put that into perspective. If you buy $1 million house with all cash and its value goes up 10% to 1.1 million, you made a 10% return. Nice job, right? But let's apply leverage. If you buy that exact same house, but you only put 200 grand down and use an $800,000 loan for the rest, that same $100,000 increase in property value is now measured against your $200K investment. Bam! Your return instantly transforms into a massive 50% return on your money. See? Leverage literally multiplies everything. And here is where we get into the real billionaire playbook. You've probably wondered, how do these guys avoid massive tax bills? Well, it's because leverage is really a game of collateral. When Elon Musk wanted to buy Twitter, he didn't just sell billions of dollars of Tesla stock. That would have triggered monstrous, insane taxes. Instead, he used his stock as collateral and just borrowed against it. Because borrowed money is not classified as income, there are 0 income taxes to pay. Leverage legally shields you from taxes, which, let's face it, is the biggest drag on wealth creation. But here's the catch. Leverage only magnifies what you actually own, which leads us straight to Law 4. Cash flow keeps you alive, but equity makes you free. So many high earners get stuck endlessly chasing the stability of cash flow. And look, cash flow is great. It pays your mortgage, buys your groceries, funds those nice vacations. But equity? Equity is the wealth you're building for tomorrow. Take McDonald's. Everyone thinks they're in the burger and fry business. And sure, the burgers generate the daily cash flow. But their true wealth, the real equity, that comes from $1.6 billion in global franchise royalties and a staggering $45 billion in real estate holdings. To get truly wealthy, you either need to own equity in your own business or aggressively use your cash flow to buy equity in someone else's. Now, leverage is incredibly powerful, but it will absolutely ruin you if you don't understand the non-linear risks involved. So let's look at part 3, the shield: risk, sizing, and diversification. Law 5 tells us that risk and reward are not linear. The wealthy are always looking for asymmetric risk. Just think about how venture capitalists operate. If a VC puts $100,000 into 5 different startups, their maximum downside is strictly capped at losing that $500,000. And honestly, they fully expect 2 of them to completely fail and 1 to just break even. But the magic happens because one of those companies might give a 10x return, and that last one, it might absolutely explode for a 100x return. By strictly capping their downside, they expose themselves to an upside that pays for the entire $500,000 portfolio dozens of times over. The goal isn't to win every single time. The goal is to set it up so that when you do win, you win so big that it completely erases all those small, calculated losses. But chasing that upside blindly is incredibly dangerous, which brings us to Law 6. Do not bet the empire for a pot of gold. To show you what I mean, there's this really heartbreaking story of a couple who systematically saved up over $700,000 across 15 grueling years. Then, a friend brought them a quote-unquote no-brainer oil deal. They got greedy, and they put their entire life savings into this single opportunity. 2 years later, the whole thing collapsed. 15 years of hard-earned savings vanished instantly. The lesson here is absolutely crucial. It's all about sizing your bets correctly. You never, ever risk the machine that produces your wealth on a single swing of the bat. To avoid that kind of catastrophic loss, you really have to follow billionaire investor Ray Dalio's rule on managing risk. See, most amateur investors try to increase their returns without paying any attention whatsoever to the risk they're taking on. Dalio flips this entirely. He says your primary job as an investor is to look at an opportunity and figure out how to reduce the risk while keeping the expected return exactly the same. You have to aggressively protect the machine, your core wealth, so that you actually survive to invest another day. And how exactly do you protect it? Well, Wall Street's biggest diversification myth gets totally shattered right here by Law 7. Wall Street tells you to spread your money across everything, right? But the ultra-wealthy do the exact opposite. As this matrix shows, your strategy should really be dictated by 2 simple things. Do you understand the risk, and do you have control? If the answer to both is yes, like if you're running your own business, you concentrate your wealth. You put all your eggs in one basket and you watch that basket like a hawk. That's exactly why billionaires keep their net worth heavily concentrated in their own companies. You should only really diversify as a hedge against ignorance when you don't understand the risk and you lack control. All right, we've shattered the old rules and we've learned the laws. Now, for part 4, the ultimate money decision system. It is finally time to reveal that exact decision framework I promised you at the start of this explainer. Knowing the laws is one thing, but you have to operationalize them. Before you invest a single dollar of your hard-earned money, you must aggressively run your opportunity through these 5 exact questions. Question 1. Can this compound? Meaning, is this a genuinely good long-term hold where time will do the heavy lifting for you? Number 2. Who has control? Is it you, or are you handing all your power over to someone else? Number 3. What happens if it totally fails? Do you get some of your money back, or is your downside completely exposed? Number 4. Is the potential upside truly meaningful and significantly larger than the downside? And finally, number 5, do you genuinely understand the risks? Like, could you sit down and clearly explain to a child how the business works and exactly what could go wrong? Running through this simple checklist guarantees you cap your downside while maximizing your momentum. So now that you understand the laws that determine whether your money magically compounds or tragically disappears, the ball is entirely in your court. I want you to take this 5-question framework, apply it strictly to your very next financial decision, and just watch how shifting from broken rules to unbreakable laws changes your life forever. You know the laws now, so what will your next move be?